Hi, welcome to Market in a Minute. So we've been thinking about the bull case. We think that there's really a lot more upside potential, um, but you need rates to come down. So we're not at valuations that are quite as high as it was during the tech bubble, but we're getting there. And we can see a path to getting the same sort of valuations. But interest rates need to come down, and we think we're on that path to seeing that. We think in general, individual stocks are so much better than the stock market itself. So this is kind of a stock picking sort of environment. Our view of valuations is that they're really stretched for the market, but underneath that, there's some really compelling values still. But just keep this in mind. This is important. It's not so much what you're doing. If you're an astute investor, you're picking the right stocks. The guy next to you may not even know what the companies do that he's investing in. So, just keep that in mind. The broader market, I don't think is, really astute as to what these companies do, what their earnings are, what the valuations of these companies are. So when things get tough, I think you can see a major pullback in a lot of these momentum-driven names. Veryu had great data. So if you follow what we've been doing, we like this stock. We think it has a lot of upside, and I want to go through that in some detail. So stock market update. The geopolitical risk, they're fading. The U.S. military, man, full display. The B-2 bomber, it just puts everybody in their place around the world. The United States can strike anybody, anywhere, and be undetected. So we think Russia is going to come to the table. They're going to resolve their problems and have a peace treaty. I think Trump and Putin are talking, so that's going to go away over time. And China, I think China's probably dismissing at this point any sort of near-term attack on Taiwan to take it over. Wouldn't that be funny if Taiwan became the 51st state? Seriously, that's not going to happen, but, wouldn't that be funny? July 9th is the cutoff for the tariffs. So we think there's going to be some positive news and some negative news. I think generally it'll be more positive than negative, so that's coming. That'll be a catalyst to keep the market going. The big, beautiful bill, I don't like calling it beautiful at this point. It's going to have to prove itself, but I think that'll get passed. What's interesting is the bond market seems to like it. So yields on the 10-year Treasury have come down, partly because of probably lower inflation, but the yields have been coming down. I don't think the bond market's spooked about this bill coming, and it seems to be a pro-growth oriented as well. So I think what the bond market's looking at is that the deficits are going to shrink over time. We're expecting the Fed to cut rates, maybe not in July when they meet, but I think likely in September. Just keep in mind that they're way behind where they should be. We think that the rate should be 1.5% lower. So they're 1.5% too high, and there was a Fed governor came out last week that said about what we've been saying as well. Our view has been that, look into the July earnings. As the stocks go up into the July earnings, take some profits, because here comes August, September, October. These are tough periods for the stock market seasonally. So we think that at best case, we're going to see some chop during that period of time, and maybe a nice 5% or 10% pullback. But it all depends on what the Fed does, I think, in July and how it sets up September. So we think that if you look out, you can see the stock market nicely higher, but the valuations are stretched. So one of the most important thing is the Fed meeting coming up in July, how they spin that, and also the earnings for the second quarter. You can see here, I circled this. The S&P earnings are expected to be up about 5% for the second quarter. That's very modest growth. It's all coming out of tech at this point, communication services and technology. But if you look at like the healthcare area and financials. I think financials could be a lot better than what the expectation is. So some of these groups here, I think, could do much better than expected. The consumer the consumer stocks, meaning the staples, I think could do better as the foreign currencies are translated back to U.S. dollars. That's for international stocks in general. I think the revenues are going to be coming in looking better than expected, and therefore probably earnings be better than expected. Now, valuations. If you just take the tech bubble valuations back in 2000, 24 times, we could get there again. So if we get there again on next year's earnings, and next year's earnings could actually end up being a little bit too low as Trump's big beautiful bill gets passed and that stimulus coming through, and all the capital spending that he's arranged to come into our country. The capital spending could be a really nice positive for the economic growth. So we could see earnings coming in a little bit better than expected for next year, higher than the $300, and you put a 24 multiple on that, you have $7,200 on the S&P 500, and that's 16% upside from where it is currently. So what I like about how we manage money is we could change our mind tomorrow and say, hey, this is not happening. The Fed had a bad meeting, earnings didn't come in place. We can protect our portfolios. So if it doesn't continue to play out as kind of what we're thinking, kind of tough August, September period, October, and then a nice rebound in the next year, we can maneuver our portfolios. Risk management is really important to us. Now, another way of looking at the valuation. So you got 22 times here on the S&P 500. It's back to the high end of its range. You had a really nice bounce off that bottom there that we had in April. And then if you look at the Fed model, what the Fed model is essentially is the earnings yield of the S&P 500 minus the 10-year Treasury yield. That tells you how much the spread is between the two. So it's currently only 0.3% spread between the S&P and the 10-year Treasury. So usually, you can see back here, usually there's a nice spread. If you look back further in time, it's kind of odd to have the S&P being so close to where the 10-year Treasury is. Usually there's a nice risk premium there. So last time it was really, really high. It was back in 2000. So what we do think is going to happen to alleviate this concern is that interest rates are going to drop. And as interest rates drop, it makes the valuations of stocks look more attractive. Now, there's one area of the group, consumer staples. We've liked them. We've been wrong. The yields on those stocks, they're nicely above the 10-year Treasury. So as rates get cut, people have to look for other places to put money. Those are just steady, nice dividend yields. Probably Pepsi would be our favorite at this point. Now, Veru, okay. The data reported last week was just terrific. So what they did was their extension study for lean muscle mass if you're on GLP-1 drugs, right? So losing lean muscle mass is a big problem for these GLP-1 drugs. So their study, phase 2B study, was really good. That was reported early in the year. Now what they did a rescue study. So if you're on the GLP-1 drug, you come off of it. You stay on Veru's drug. And what they showed was the weight loss continued, but it was the fat you lost and you gain lean muscle mass. That's the best of all possible worlds. So also, the safety data was really positive. Basically, there's no issue with the drug at all. So the next step is they'll meet with the FDA in August to discuss what they're going to do on phase 3. They're going to have to raise some money. They're going to have to they'll partner the drug, or they're going to have to raise 40 to as much as $80 million to do the phase 3 study. So in this sector of the market, basically Veru is the last company standing. So everything else is kind of failing or should be, put out to pasture, like the Lilly drug. There's really nasty side effects of the drug. They shouldn't continue with it. And so everybody's basically being eliminated that's trying to preserve that lean muscle mass. We think that Veru is in discussion with multiple large pharmaceutical companies, including Lilly. So we think that there's a possibility that Lilly may be funding their phase 3 trials. So what we usually see on these type of situations where the stock is low, the company doesn't want to sell because the stock's low. They have to get it up quite a bit more to make it lucrative enough to do a sell to another company. But what they'll do is they'll do a partnership with a company like Lilly and say they do it at, instead of at 60 cents where the stock is now very low, it's been much, much higher. They'll do it at, say, $2 a share. Lilly might give them, $50 or $100 million to do the trial, and then they'll license the drug from them to set up some really nice royalty revenues for this company. Now, there's a research report out by Cowen. Cowen has this market, the lean muscle mass market, being a $30 billion market over time. So this could be a huge winner. So just keep in mind, biotech is really speculative. You can't own just one. Veru we like. We've done a lot of research on it, but it could be, it could fail. But we think they de-risked their drug with this beautiful phase 2 and extension study data. So if you have any questions, ping us anytime. If you want help on your money management, we work for advisors. We manage strategies for advisors and for individuals. So just come to my website, Patrick M. CFA, ping me, sign up for a hard copy of Mark in a Minute. And you know what? We haven't been asking people to do this for a long, long time. But if you like what we're doing, please hit like. Take care. Have a great 4th of July.